Right now, Autozi Internet Technology, ticker AZAZ, is trading live at $0.1175, and it is surging today, up over 19% on absolutely massive, truly staggering volume. And seeing a pop like that, seeing that green percentage, the immediate expectation is that this is a turning point, that good news has finally hit, or that the market has suddenly realized the potential of this company. But the reality is, what you are watching is not an institutional re-rating. It is a speculative frenzy in a stock that is down over 90% in the last year. The volume we are seeing today is astronomical, with hundreds of millions of shares changing hands, a figure that rivals its entire outstanding share count. This isn't a recovery, it's a battlefield. This is the kind of high-velocity, high-risk trading that many investors using platforms like the Robinhood app or SoFi Invest are drawn to, hoping to catch a rocket, while long-term holders on platforms like Fidelity or Interactive Brokers might be looking at this as a chance to finally cut their losses. The common ground, the story that gets told about Autozi, is admittedly compelling. The expectation is that this is a high-tech Chinese company with a sophisticated supply chain cloud platform. You hear terms like SaaS, S2B2C business models, and a digital ecosystem connecting manufacturers, insurance companies, and thousands of local repair shops. It sounds like a scalable, asset-light operation, the kind of disruptor that investors are always hunting for. But you have to challenge that. You must look at the reality, which is buried in their financial filings. The reality is that Autozi is in a fight for its corporate life. This isn't a sleek tech company. It's a company that just received a non-compliance warning from Nasdaq in July because its market value has collapsed so far below the $50 million minimum requirement. It has until early 2026 to fix this, or it faces delisting. That is the cloud hanging over every single trade. Let's break down the recent market movement, because this 19% spike today is a classic example of expectation versus reality. The stock's 52-week range tells you everything, a high of over $3 and a low of around 7 cents. This is not the chart of a stable business. This is the chart of a micro-cap stock that has been almost completely wiped out. So when it bounces 19% from the floor, it's not a sign of fundamental strength any more than a 19% bounce in Tesla stock or Apple stock would be. Those companies move on product pipelines, earnings, and macroeconomic trends. AZI is moving because it's a sub-dollar stock with enormous volatility, making it a perfect target for day traders. The massive volume we are seeing today is not coming from Schwab Intelligent Portfolios or Fidelity Wealth Management gradually building a position. It's a rapid-fire exchange between short-term traders, many of whom won't hold the stock for more than a few hours or even a few minutes. This kind of online investment is pure speculation. Now, let's look at the financial reality that's fueling this. The company reported its first half 2025 results back in September, and the headline number was exactly the kind of thing that creates a false expectation. Revenues were up 69.6% year over year to $79.9 million. That sounds fantastic, but the reality is in the details. That revenue growth came from a strategic pivot away from other business lines and into auto parts and accessories, which now makes up 98.7% of their total revenue. They are no longer a diversified tech platform. They are, for all practical purposes, an auto parts distributor. And what kind of margins does this new core business have? A razor-thin 1.7% gross margin. That's not a typo, 1.7%. So while revenue went up, the operating loss widened to $8.1 million, and the net loss increased to $5.3 million. They are selling more and losing more. The company's own filings have warned of going concern issues, citing an accumulated deficit of over $130 million and negative working capital. They are burning cash, and the recent pop in general and administrative expenses was attributed, among other things, to consulting and financing fees, which tells you they are busy trying to restructure and find capital. This is a good time to ask, how many shares of AZI are you currently holding? Comment below with your position. I'm curious to see how many people are trading this actively versus holding it as a long-term investment. So, what does Autozi Internet Technology actually do? The expectation, as we said, is a life cycle automotive service ecosystem. The reality is that they are a Beijing-based holding company that, after its recent pivot, primarily sells auto parts in China. The cloud platform and SaaS elements are the infrastructure they use to manage this distribution network. This S2B2C model, suppliers to business to customers, is about connecting the big parts manufacturers to the thousands of fragmented, independent multi-brand service or MBS repair shops. It's a logistics and distribution play, not a high-margin software play like NVIDIA stock. They are trying to be the middleman in a notoriously difficult and fragmented market. And while they talk about new strategies like electrification and globalization, the core business right now is a low-margin, cash-burning operation. This is why a self-investing individual using a platform like Robinhood or SoFi Invest needs to be so careful. The story sounds high-tech, but the numbers look like a struggling distributor. Let's talk about the future outlook, because that's where the expectation-reality gap becomes a canyon. The biggest catalyst and the biggest risk are one and the same: the Nasdaq delisting notice. They have a grace period. If they cannot get their market value of listed securities back above $50 million and keep it there for 10 consecutive days, they will be kicked off the exchange. A reverse stock split is a common tool to fix the bid price requirement, but it doesn't fix the market value requirement. They need the stock price to go up dramatically or issue a massive number of new shares, which would dilute current shareholders to almost nothing. The recent news of new financing agreements, canceling some warrants and issuing new convertible notes, shows that management is in survival mode. They are trying to manage their debt and stay liquid. This is not about growth, it's about survival. This is not a stock for a set-it-and-forget-it intelligent portfolio. This is a high-risk gamble. The bull case, the one-held expectation, is that their pivot to auto parts will eventually scale, margins will magically improve, and they will successfully use their platform to become a key player in China's automotive aftermarket. The bear case, the reality, is that this is a company with negative shareholder equity, widening losses, paper-thin margins, and a formal warning from the stock exchange it trades on. The 19% pop today is just noise in a much larger story of collapse. It's a signal of speculative interest, not fundamental confidence. When you are looking at your individual brokerage account, whether it's with Fidelity Investments or Interactive Brokers, and you see a stock like AZI, you have to separate the exciting story from the grim financial facts. In the end, the narrative of a Chinese tech disruptor using a cloud platform to connect an entire industry is powerful. But the reality of Autozi is that it's a company that has been forced to pivot into a low-margin distribution business just to generate revenue, all while burning cash and fighting to stay listed on the Nasdaq. The pop today is a fascinating, high-speed glimpse into a speculative frenzy, but it does nothing to change the fundamental precarious reality of the company's position. This is a story of survival, not a story of disruptive growth. This video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly. Don't forget to like, comment, and share this video to support the channel.